Welcome to Automotive EV. My name is Peter Wooding and thank you for joining us. Today I'm joined by Ben Waller, who's Associate Director of ISTP, and he is going to run through their insights into future automotive distribution. So welcome, Ben, good to see you.
Hi, Peter. Thank you very much for having me. This is
a pleasure, and thank you for joining us. So if it's okay, I will hand over to you if you want to give a short introduction of who you are and then what your findings are.
Yeah, okay, great. Thanks, Peter.
Thank you.
Well, firstly, thank you very much for this slot. It's been a while since I've presented ISTP's view of the world. I've been with ISTP on and off for over 20 years in various roles. I work in other areas, but I do work for them as an associate director for ISTP. So, yeah, what I'm going to give you today is basically a reminder as to who we are and what we do, and also our view of the future for automotive distribution, the challenges for the next 5 to 10 years, and then wrap up with the implications for outbound logistics and logistics in general. And hopefully we'll have time for questions. I definitely appreciate and invite them. So either put them in the chat to Peter and he'll try and keep an eye out for them if I can't see them. So without further ado, ISTP, for those of you not familiar with who we are, was established in the early 90s and provides services in 3 areas exclusively in automotive distribution. So firstly, there's a collaborative research program. This is an annual research cycle. The members subscribe annually. The scope of the work is agreed with the membership and the outputs is shared amongst the membership internally. On top of that, we do consultancy. So with both members and non-members, it obviously leverages the expertise of the group of ISTP as a collective of a range of people with different areas of expertise, and we would argue it's quite a cost-effective model of subsidising the research and also some good value for money consultancy. Okay, my computer is frozen. Let's see if I can move it on. Thank you. So. And then there's data services. So we provide data on dealer networks. ECDH is published every year. We do updates on aftermarket trends, including our forecasting, structural forecasting, and we do consumer surveys on a regular basis as well. Our members come from across the industry, mainly at headquarter level. So the manufacturers, as shown in the top 2 lines of brands, importers such as Emil Frey, D'Ieteren, who are also large dealer groups, OE suppliers such as Total, parts distributors, LKQ, and then repairers, insurers, online platforms, and a range of other players as well, such as trade organisations and IT and service providers. We are mainly focused on cars, and we're mostly focused on Europe, but we have knowledge in other areas. Done a lot of work in Brazil, China, Australia, for example, and I worked, for example, ISTP Australia many years ago. And we've also done work in LCVs as well in the past. So what I wanted to talk about today is our view of the accelerating change in the sector, automotive distribution as a whole, and what that means for all partners, and eventually I'll come on to the implications for logistics providers, but hopefully it should be implied through all of the areas that I'm going to cover. So the industry largely accepts that change is inevitable. It's been a sector that's been remarkably resistant to change over the decades, but it's accepted as inevitable, and in fact much of it is now being forced upon the industry. And so we're now, as a sector, focused on the choices and the risks involved in transitioning to new forms of business. So the 3 key areas I want to cover today. One is digitalisation. So what is the difference that digital everything will make to those in the sector? Secondly, what the implications are for this on relationships between different providers, and partners in the automotive value chain, and how to build stronger partnerships to make those work more effectively. And thirdly, the significant changes we're seeing in product and wider technology that consumers are using, and how, as an industry, this will force us to adapt and change how we do the business, operate our businesses. So it's largely about managing choices and risks, trying to understand where to invest, where to punt on expectations of change, and to anticipate trends and focus investments in the areas that will make a tangible and real difference. So I'll go through those three topics in sequence. So firstly, digitalisation is affecting all aspects of customer behaviour, products, and sales channels. So I'm going to go through these points in a little more detail on the following slides, but these are just the highlight points that our research and data supports. Firstly, new car buyers will continue to travel twice as far to buy a car as for service. So networks are not uniform. The traditional sales service tie is coming under far more strain than it ever was in the past in franchise networks. Most new car buyers would prefer to buy omnichannel. What that means is a mixture of online and offline activity. And following online research, car buyers actually do more physical shopping, more actual browsing at physical outlets. Connected cars offer the potential for added services, but that's still early days really, and that's in that area, and the value is still to be realised for manufacturers, repairers, and others in the value chain. Connectivity enables improved after sales, as I've just implied, but the net benefit may be limited, offset by other areas, which I'll come on to. So car sales and increasingly after sales must be omnichannel. Customers expect online and offline capability and interaction. The dealer environment will be transformed by OEM-driven retail platforms, online retail platforms. Used car supply chains in particular may look very different in 5 to 10 years' time, transformed through better management, through big data, basically, in terms of fleet management, defleeting, remarketing, and so on. And this will be aided by the digital trail left by customers who will help fleet managers time and value their defleeting actions. So digital channels enable customers to be better informed, influencing their behavior. So as I said, customers like visiting dealers, and despite, you'll hear a lot of apocryphal stories that customers don't visit dealers as much as they used to, whereas our research suggests the opposite is true, that over recent years, obviously the last 18 months has been an exception to the rule, but visits to dealers and the number of dealers visited have been increasing. Secondly, as I said before, customers will drive twice as far to buy as they will to have their car serviced. And customer tolerance on driving distances seems to be increasing. And all of this supports more cost-efficient retail and after-sales networks, also with implications for the independent sector. When we ask customers about what their ideal buying journey, and we will update this this year, see how much that might have shifted during the pandemic, but certainly when we last looked at this substantially, 2019, across all age groups, so you can see the age groups in that chart, the great majority wanted a mixture of online and offline sales channel journeys. Clearly, there may be more people at the moment who have become more comfortable with purely online activity, but we anticipate that customers will go back to needing and wanting some kind of local support and activity for buying and clearly, obviously, more tangibly for after sales. So even after the lockdowns, few buyers, it seems, from the surveys we've seen, other buyers over the last 12 months want to do their entire purchase online. So physical outlets will remain a key part of the process for many. And customers do a lot of research, and that empowers them, and the good dealers are responding to that and engaging with customers who are quite knowledgeable, and because they've done more research, they want to come and discuss with dealers a bit more about the product and the services they're buying. Secondly, connected cars will bring manufacturers much closer to customers. It enables closer relationships and new services. It's the mega trend that underpins the other ACEs, so autonomy or semi-autonomy, as we'd put it, electrification and shared transport. The penetration of connected cars is growing rapidly in Europe, up from just over 9% in 2019, anticipated to be over 20% next year, and growing to 30% in 2025. OEMs are rolling out functionality. This is an example of what I see when I log into my BMW i portal. Teleservices for after sales, connected drive services, remote services on the app, and sort of things like invoices and support. However, manufacturers and others are still struggling to genuinely monetize connectivity. A quote from the late Sergio Marchionne: talk to consultants, they'll tell you the most valuable thing they have is data. Then we go to Google and ask them what they'll pay for it, and they've said they've already got it. So his bottom line comment was, you've got to be careful before building economic models around data itself. It's really about finding uses for the data in your own business plan. And yes, in terms of after sales, predictive maintenance is certainly possible, and in heavy equipment sectors it's already there. But there's clearly a role for focus on the more critical events and to try and reduce warranty costs. That's where the manufacturers are interested in, is certainly within the first 2 to 3 years of ownership, to make sure they and their suppliers are minimizing their warranty costs by making sure they can effectively, not just through recalls, but through other activity, making sure that their cost of maintaining those cars is minimized. So that's where we see the early gains in that area. Channel structures, processes, and IT must reflect these changing customer behaviors. So at the top left, we've got 2 examples of buying journeys, one in purple, one in orange, and a range of channels. So OEM online and offline, dealer online and offline, and third-party platforms. So through from awareness, through to considering choice, and price, and availability, finance, and so on, customers will interact with these different supply chain partners and channels in getting to buy or lease a vehicle, for example, and they will drive the process rather than be dictated to by dealers or manufacturers or anyone else. And the journey has to be flexible enough to do that without customers having to start the conversation again. So there's a need for a consistent process across all channel partners. This will mean a transfer of investment focus of where the money's being spent away from physical networks to improving the digital channels, providing full transaction capability and the functionality along all of that customer journey. This will mean a lot of data sharing across networks, subject to GDPR, obviously, to enable customer channel switching. And there's also a bigger prize for the OEMs and potentially others, maybe some of the large leasing companies, but primarily the OEMs, to improve their vehicle lifecycle yield or business plans as they see it through the application of big data. So an example of a repetitive leasing business model that we call build and operate. So the OEM, through its sales and marketing platforms and online channels, will be monitoring new customer interest by types of offer, which drives the promotional focus on spend to entice and respond to customer demand, analysing what the customers that leave and the costs of that and the things that they're deciding not to buy. This will influence the operating fleet, the product and services on offer, but the product in the existing fleet offered to customers for leasing and so on. And that will be defleeted as it is today on the basis of age and or condition, but there'll also be refurbishment and reconfiguration between leases. So more than just one leasing ownership cycle. And And then the pace of that defleeting or new vehicle supply fill up of that fleet will be aligned to incoming customer demand. This all means that manufacturers will be planning a lot more volume and mix planning for their owned fleet, an extension of where they're at today with huge amounts of cars on their balance sheets as on the finance arm. So lots of opportunities there, and lots of manufacturers are looking at that quite seriously at the moment. So the next area I want to look at is relationships. So relationships will evolve as a result of what I've just talked about in omnichannel, in digitalisation and consolidation. So as I said, manufacturers will inevitably have more direct relationship with customers. Physical networks will evolve to reduce the cost of distribution. As part of the pie, they need to be leaner to allow for more investment in digital services, for example. Dealers will remain key for most manufacturers, but their role will change. I'll come on to those points in more detail in a moment. Secondly, data will become a network resource for supply chain and value chain partners. Third-party platforms will continue to enter the space and leverage any efficiencies or gaps in channel relationships, such as brokers, for example. And a key factor that's defined the automotive distribution sector pretty much for the last 100+ years, entrepreneurialism, think about franchises, for example, that will decline as the business becomes more data-driven and becomes more enterprise-like in its integration. The implications of this is that for franchise and other investors in the sales channel space, the brand portfolio will become more focused at the investor and outlet level, so perhaps fewer brands per investor. The mid-sized players will be the most at risk, unable to find a role in this kind of system. And the consolidation of manufacturers, which we'll continue to see, dealers, which we're continuing to see, and repairers and distributors will all change the balance of power in that value chain. So firstly, manufacturers will have direct customer relationship alongside lower cost physical networks. So direct sale channels, more digital and over the air services, for example. And we've seen a year-on-year increase in the captive finance and insurance bundled offered by manufacturers. This will all be integrated into omnichannel, so integrating all partners into these processes. For franchise partners, this means more fees for services, less risk. This might be a modified franchise, or as some manufacturers are experimenting with, agency models as opposed to traditional franchises. Whichever route they take, we anticipate a greater focus on centralized new vehicle ordering and stock management, regardless of whether they go for that full build or operate, or whether that's just a component of their business plan. We'll see less of the gin palaces and more multi-franchising, more mall-based outlets, and more innovation in after-sales, such as mobile servicing to cover gaps in network coverage. Data will drive the relationships between supply chain partners. It'll also drive the supply chain dynamics and areas which traditionally have been quite, I guess, unscientific, which is, for example, pricing. And as I said, the entrepreneurial scope for sales channel partners such as franchise dealers will decline. So data as a network resource, that shared data will enable demand sensing to understand better what customers are liking and not buying, and even use of the car itself. If we think about connected car, the insights that manufacturers are getting now as to their products as they're actually used is quite unprecedented. Lead management in the traditional sense, but for various forms of sales, including various forms of leasing. Dynamic pricing, if you think about sectors such as some of which have not had a great 18 months for obvious reasons, the transport travel sector, where dynamic pricing has long been employed, whether it's hotels, car rental, or airlines. Some of that science is being looked at by manufacturers in terms of how they can manage their leasing models. After sales loyalty, upselling during usage and ownership, and to understand the points at which customers are looking to replace a vehicle. Third parties will still exploit gaps. So brokers like CarWow, for example, customers are looking for objective reviews, price comparisons. They want transparency. They want to compare price, finance offers, trade-in valuations, and different bundles offers. And third parties will find a place to compare OEMs and other providers in that space. And as I said, all of this means a shift away from the traditional salesperson role within a franchise dealer. Less instinct, less gut action, following their gut, and going for traditional sales techniques to close a deal, and more to an enterprise-wide service-orientated culture, and that does mean a change of people and skills within the networks as well. So the scale of these investments and the greater focus on process and IT will favour the larger players. So the mid-sized players face most risk. This applies to all types of players: dealers, repairers, including independent repairers, parts distributors, for example. Those in the middle will struggle because they won't be big enough to maintain investment and skills, but they're too big to have that personal contact with customers, which small repairers and smaller franchise dealers have. Smaller players can find niche opportunities, either specializing in certain products or areas such as electric vehicles, used electrics, for example, or in rural areas where small outlets have a big impact. Power between partners will be more balanced, so the need to build scale to invest in new skills and new technology will drive further consolidation. This will tend to drive more reliance on processes and on IT, and individual players will be less reliant upon single relationships, as the dealer groups already are with many OEMs, many service providers, and the same is true of logistics providers as well. And so there should be, with the greater consolidation in all parts of the sector, there should be more less OEM dominance and more push for win-win solutions. For franchised dealer groups, for example, we expect more balanced brand portfolios. So having lots of different brands in a portfolio for a large dealer group like M/I will become more challenging in service, repair and parts due to the brand specific investments. Earning a place at the table will also, to be taken seriously by a manufacturer, will require a minimum level of investment that may be beyond quite a few players. Again, there'll be a place for the smaller players who will continue to have a particular place, for example, in rural locations. But we expect fewer brands and a stronger position in each. So a dealer group, we would expect to have fewer brands in their portfolio with more heavy investment in each of those brands. Product and technology evolution, another area of significant and accelerating change. So products will be increasingly services rather than hardware. That's a major shift for the automotive sector. Obviously, we've always been focused on the metal. Dealers and many involved in the sales channels, particularly so. Customers will be less education, but also other innovations coming down the road, such as potentially synthetic fuels, and maybe 10 years plus, maybe hydrogen fuel cells will emerge as a significant challenger to other forms of powertrain. But EV is the dominant player at the moment, and lots of customers are not familiar with the product and require much more advice and support. We also see an increasing opportunity to bundle products and services over a period of time and not a one-off transaction. So more of an account management perspective rather than a one-off sales opportunity every few years, which also doesn't help in terms of customer satisfaction and meeting customer needs. All these changes in technology on the channel side, on what's being offered as services, and the new complexity of the products themselves will require greater expertise and investment, forcing specialization. So nobody will be able to do everything anymore. It'll be it'll be challenging, and certainly across too many brands. Another area we see a significant change is the role of over-air telematics, and the requirement for physical interaction with the product will reduce in after sales. That's an interesting one because it's still early days for that, but I'll come on to an example of that in a moment. And co-opetition, meaning more cooperative competition, will become more common as a balance is struck to optimize coverage and in skills and investment, particularly clear in after sales. I'll come on to that as well. So again, it comes back to a focus on the customer, on services, away from product. So customer retention will become more important as margins come under the pressure, which they will. Margins are already under significant pressure from EVs, for example. Marginally profitable businesses will not be able to survive with the pressure on revenue, costs, and investment. And that is particularly true of some of the less sustainable mobility concepts. I haven't got time to go into that in particular, but it's clear that some of the subscription services, which we already thought were not particularly viable, have been forced out of the market in the last 18 months. And after-sales business volumes and mix will deteriorate in mature markets, with B2B replacing B2C. What we mean by that is that more customers will be paying for the whole package. And if customers are paying for the whole package, whether the car's being serviced by an independent repairer or a franchise dealer, fleets already heavily use the independent sector for servicing, for example. And as that bundle grows, the overall revenues will be lower because manufacturers will be paying less for the dealers to do that work than the customers would have been doing directly as a separate payment. So that's a significant shift which impacts on the viability of traditional outlet economics. Physical products, they may be simpler, but the services, as I said, will multiply, and in particular, we think pay-as-you-go services will grow. So there's the product, which in many cases is simpler. A lot of EVs are simpler than their ICE counterparts. There's Volkswagen's leading product, for example, at the moment. But bolted onto that is all the Volkswagen we services as ancillary services, which offers a lot of flexibility around how the car is used. All of this means that customers are a little bit baffled. They're baffled by powertrain changes. They're baffled by some of the ADAS and other driver assistance and semi-autonomy that's coming on stream. And they're also increasingly baffled by the range of funding options. What is a subscription? What is a lease? What is a bundled lease? What is a service plan? Our research constantly finds that whilst the fleet sector, with professionals, buyers know what they're doing, a lot of retail customers are completely confused by all this stuff. And again, pay as you go, bundled in, everything all in one payment. We expect to increase from manufacturers and from other providers, third parties. So, flexible commitment with your choice as to how you put that together, a bit like a mobile phone contract. These things have been around for a while. The fleet sector, very mature. In the retail sector, still evolving, despite some manufacturers like Peugeot and Citroën, both pioneering them for several years, for many years. And then supporting sales and after sales will become much more demanding, driving what we call, cooperative competition or co-opetition. There'll be greater expertise and investment needed for all players, forcing specialization. Just one example, which I haven't got time to go into detail on, is the changes happening with ADAS and other technologies to windscreens. What was a fairly simple job, replacing a rear windscreen, for example, all of those elements on that graphic need to be taken into account for as part of the technology that is the windscreen, and all of which needs to be calibrated afterwards with technical equipment. And that's just one sector. That's one part of the repair and maintenance area. And even if you're a specialist in glass, that's a lot of stuff to be taken into account when previously it was a fairly simple job of removing and replacing a piece of glass effectively, and maybe adding just a heater to the back. We also see a reduction over time in the physical interaction with the product in after sales. So, as I said, BMW also has some of this capability to a limited extent. It's very mature in heavy equipment. Most obvious example is things like combine harvesters. But at the moment, the economics don't favour it at the car level, but it will come. Ford Live is already offering this to LCV users. So there's basically uptime, as you would have for heavy equipment. And when the vehicle's down, the Ford are not charging for it. So there's the commitment to support that vehicle in the field. But the data will allow more pushes, more diagnostics remotely, and potentially even some fixes remotely as well. And certainly upgrades and changes to software. Tesla already has it. Other brands have it to a greater or lesser extent in their newer models. So co-opetition. This cooperation between different specialists, because nobody will be able to do everything, will become more common as a way to balance off the needs to invest in expertise and specialization, and to make sure there's coverage and coordination between different partners. And an area where that's very clear is in the parts distribution and logistics market for after-sales parts. So, for example, parts consolidation is happening across all areas of aftermarket parts across Europe, all different parts of the sector, and scale efficiencies is driving convergent, authorized repair and independent motor trader parts distribution strategies to serve both those parts of the repair ecosystem. 3 examples: PSA and Stellantis's strategy with Distrigo is well established in growing and through an expanding range of parts. So what they're basically focusing on the independent sector, as well as the franchise sector, with a range of parts, including alternatives to OEM parts, OES original parts as well, and second and third line parts, improve logistics to share the costs of storage and distribution and transport and delivery of those parts, and a competition. So bringing in different types of player, franchise dealers, independent parts distributors, to create a network of parts logistics which no one of those partners could provide on their own. Dealer groups are also doing the same thing, the larger ones. So Groupe Dubriel in France is a good example of a group selling both franchised and non-franchised OEM, non-OEM parts, and growing sales to the independent sector, independent repairers. And the largest independent European distributors have seen significant growth in recent years. Those some of the brands on the right: LKQ, SAG, Intercars, Mechanon, PHE, and GPC. We've seen their growth of the market shift quite significantly from 13% of the parts market in 2014 to over 21% in 2019. So in all parts of parts, after-sales parts, logistics and distribution, we're seeing significant consolidation. And as I said, that's one way of dealing with the complexities of the range of products coming out, and the level of expertise needed to support, store, and fit those parts. This greater complexity and this transition from business to consumer to business will again reduce margins, making customer retention critical. So volumes and mix will weaken. So this chart here, hopefully you can see, it's a bit on the small side, but the passenger car park with managed after sales at 2030 forecast, that's both for France and for the UK. Particularly if you look at the park under 4 years old, you can see the significant growth of OEM controlled and other controlled after sales. That's either through a fleet leasing company managing the whole after sales, or the manufacturer managing it. This means that after sales, this also goes alongside after sales volumes in structural decline, which I'll come on to in a moment. But more cars will be sold with inclusive service in some form, whether it's a service plan or whether it's a bundled part of the whole monthly payment, whether that's fleet or retail, whether that's to a manufacturer through their contract or through another fleet or leasing provider. And repairers will become suppliers to fleet managers, which has a clear impact on the revenues and margins that they earn. These margins will come under pressure. It'll reduce the mix of higher margin consumer work. The lower work content in battery electric vehicles with the risk of extended intervals will also have a significant impact. We've done a lot of work over the last 18 months on the impact of electric cars on all areas of automotive distribution, but particularly in after sales. Direct part supply, particularly in body parts, eliminates margin. So lots of insurers are sending parts and creating deals with aftermarket part suppliers to bulk buy and put pressure on the margin for body repair. And we'll see more mobile and over-the-air fixes and upgrades to vehicles and fewer workshop entries as much of the work shifts, around the edges from physical work through to digital servicing and repair, basically. In this environment, not all businesses can survive. In a smaller total after-sales market with tighter margins and higher investment, this might be the straw that broke the camel's back. And in particular, dealers dependent on after-sales and cross-subsidy will suffer. So customer retention will be key. And as I'm sure many of you are aware, in the franchise sector, many dealers have become over-reliant traditionally on after-sales to support profitability, and new cars for many dealers traditionally was at best break even. On top of all of this, we've got regulation, which is becoming increasingly strong influence in all areas at the European level, the national level, the local. So firstly, we've got block exemption, which is coming up for renewal shortly, both the general block exemption and the automotive block exemption, both of which have a significant impact on many aspects of automotive sales channels and distribution. Areas that the Commission's particularly looking at the moment is digital competition, the shift from products to bundles and how that impacts upon customer choice, access to data, including independent repairers, for example, the impact of brands going direct to customers through apps, through subscription type apps, through different types of direct only offers for manufacturers to customers, for example, and all of this impacting upon retail level concentration and competition and the franchise requirements of manufacturers. So there's a whole area that we look at, and it's and with a lot of hot topics at the moment, a lot of which is around digitalisation. We've also got the focus on environmental impact. So the European Green Deal, for example, the Commission is clearly focused on CO2 reductions. And if you look at the timetable for the CO targets for passenger cars, they continue to be very stringent and stretching to 2030, which is clearly driving the shift towards electrification. On top of that, we've got air quality being a huge issue for many urban areas, with low emission zones being introduced across many cities. So, for example, on that map on the right, the dark green are low emission zones in significant cities across Europe. So all of these areas are impacting on manufacturers and channel choices and how they structure their business, and the products they sell and the products that customers are free to buy and use on a day-to-day basis. So I'm sort of heading towards the end now, but in retail channels, we expect more diverse approaches by OEMs and others, but there'll be some common themes. So we'd expect to see a progressive reduction in the scale of the typical dealer facility, so fewer huge outlets, more format variety organised into market areas, more standalone service points with some sales support role, a bit like a second or third tier franchise outlet that traditionally existed in places like France and Italy. More capable online channels, better integrated with physical outlets. Change in the selling style, as I sort of hinted at before, more consultative, less confrontational, less about closing a deal, and more about providing appropriate services which can be adapted as customers' needs change. And a mix of franchise and agency contracts, but all closer to the OEM. So franchise dealers, along with other partners in the supply chain, will all be inevitably be working more closely with the OEM. There'll be fewer players, there'll be more integrated management, and lower a pressure to reduce distribution cost. The aftermarket, as I mentioned before, will decline for structural reasons, but the independent aftermarket we expect will continue to converge with the franchise. Very obvious in the fleet sector, for example, as I said, where the largest fleets already use the independent sector as much or more than in some markets than the franchise networks. We see structural decline for a number of reasons. So the average mileage driven of the park expected to decline by 2030, and that's regardless of the pandemic. More vehicles with high mileage based service intervals in the older car park, as that feeds through into the wider repair and maintenance networks. Annual service recommendations spreading in the recent parks, so that moving back maybe for 18 months to 12 months, having a bit of an uptick in some segments, but overall reliability of vehicles is improving with a stronger impact on the older car park, meaning less work. So if we just take those four markets shown in the top left, evolution from 2017 to 2030 that we forecast, a decline in Germany of minus 14%, down to a decline of minus 3% for Italy. So a range of impacts, but a clear decline across all markets, which has been continuing structurally for many years. And in a declining market, not everyone can grow, clearly. So there will be losers who will exit or need an alternative model from their franchisers via soft multi-brand concepts. And that's particularly true in the independent sector. We're seeing a consolidation of both OEM franchised after-sales networks and independent aftermarket networks, releasing the ability to invest in connected cars, electrification, and supporting managed after-sales. And the IAM growth could be supported via more co-opetition or cooperation with the OEMs. There are plenty of examples emerging in France, Autodistribution, and there are many outlets. There's the photograph there that illustrates an outlet which is not atypical for France, which is a Toyota repairer that's also an independent Autodistribution outlet as well. So an independent and a franchised repairer. Although manufacturers may be reluctant to share their networks and processes beyond parts distribution, but I think it'll largely be dictated by practicality and coverage, particularly in rural areas away from large urban areas. Mobility, and this is a whole topic in itself that we haven't really got time to talk about, but our view is that it will not threaten exclusive access to cars, but there will be a growth of flexible leasing. So in the last year, we've seen a boom of used cars in response to the pandemic, and what's been quite surprising is the resilience of car sharing with customers cleaning cars themselves. And all of that shows a robust demand for car use. Yes, some of it has been dictated by the pandemic, but I think some of it is more deep-rooted than that. Our surveys and more recent surveys continue to show a clear preference for exclusivity where affordable. So car sharing has a role, has a place, particularly in cities, but it's not going to significantly dent exclusive car use. Mass mobility as a service platforms such as Mobilio, which is particularly focused on the fleet and corporate market, will help fleets and employers better manage the inventory of cars they have alongside corporate travel, with peer-to-peer services such as Turo and Getaround increasing corporate fleet utilization. And then the growth of flexible leasing. I mean, it's an area that's continuing to evolve. It's an area that's considered quite a prize by manufacturers and others, but difficult to get right. Lynk & Co are basically making a big play of flexible bundled leasing. Care by Volvo, very high profile global example, although they tend to be selling more longer, to 1 to 2 year bundled all-inclusive leases rather than shorter contracts. But everyone's focused on trying to find a more flexible sweet spot. It's clear many retail and fleet customers are looking for something more flexible than traditional 3-year lease, and also more customized than a traditional rental, with all the costs and the lack of focus on individual needs that entails. There are plenty of examples away from the manufacturers. Cazoo, for example, used car online channel, which have invested heavily and bought Cluno and Drover. There's Fahren in Germany, Drive It Away in the US, other examples there as well. So in summary, implications. So the implications for 3PLs and others involved in logistics, particularly in outbound, is that outbound will become more micromanaged and associated services more fully integrated into manufacturer-led vehicle lifecycle management. So firstly, driven by the need to see each car and each process, OEMs will help service providers, including logistics providers in outbound, to finally, because it's been wanted for a long time by everyone, addressed full supply chain transparency and digitalisation. Innovations such as blockchain and physical internet, which is the action of directly linking data to inventory, which is relatively straightforward with connected cars, will support systems integration between the LSPs, manufacturers, port providers, others, driving collaborative optimization, consolidated logistics flows, and automated auditing, particularly through blockchain, for example. Manufacturers will centrally commission more vehicle lifecycle services, including storage and delivery, integrating new and used car processes. As I talked about before, manufacturers are looking at multi-user cycles, and service providers will help OEMs manage monitored fleets to integrate these build and operate life cycles. And finally, OEMs will centrally decide more inventory mix and depth, digital and physical upgrades, remarketing and manufacturing. So, for example, modular technology will allow for in-life upgrades and remanufacturing. And Renault, for example, is already publicly remanufacturing used cars in a facility in France. That was a bit of a rush, but aware we've got a bit of a push on time. But Peter,
absolutely superb presentation, colossal amount of food for thought, and sort of lots of further discussion could really happen on this, but as we're all aware, we're actually over time. But thank you for that. I think if there are any questions that people want to raise, feel free to contact me directly within the EV Live, or Ben directly, and I'm sure we can get back to sort of covering. One area from me just before we sort of have to leave is, with the introduction of new models, we'll take, for example, Polestar as part of the Volvo family, that will not have a dealer network and will actually, you'll purchase online and probably have it delivered by a service provider, in actual fact, to be fair. Surely that model, and that model being accepted by the market, will increase the rate for some of the more traditional outlets to be doing the same thing, or am I wrong on that?
No, I think the demand for pickup of vehicles and drop off of vehicles, collection of home delivery will increase. I mean, fleets have been doing it for some time, and over the last 18 months, we've seen a significant growth purely in response to the pandemic, which is understandable. Dealers have been doing that largely themselves, and on the franchise side, and used car retailers as well. Cazoo most obviously, but others such as Imperial Cars, which were bought by Cazoo. But there's plenty of examples of across Europe of far more home delivery, for example. However, as I suggested, that there's a clear need for many customers to have some kind of physical touch point. Whether Polestar can maintain that radical approach remains open to question. Tesla continues to open more outlets despite starting as a very hands-off, largely online retail channel. And so I think the question will be, what happens when Polestar grows its volumes? Will it be able to sustain that purely distance selling model? I would raise some questions about whether that's possible. I think a mixture of both more traditional handover and management of vehicles plus more pickup and collection is probably going to be the future. In after sales, I can see a much bigger role for pickup and drop off, because from places of work and things like that. And that provides a role for various kinds of logistics operators. In terms of new vehicles and used cars, what I see is the big opportunity that of consolidated channel management will bring. So at the moment, used cars and new cars tend to be moved in very different logistics networks, whereas that I'd expect to see much more convergence and optimization of the two there going forward, which will involve some element of distance selling, I would say. That wasn't quite an exact answer to your question, but
it was in line, and appreciate it. So we will have to, unfortunately, now sort of call an end to the session. But thanks again. I'm sure we've got plenty of opportunities to be going into a part 2 on this to actually break into some of the individual segments in a little bit more detail. But for everybody who joined, thanks for watching. For people who haven't joined yet or probably saw a glimpse of it, you're going to enjoy this on demand. So thanks, Ben. Thanks, everybody. And we'll speak soon.
Thank you, Peter. Thank you all. Bye. Bye.
Hi, it's Peter again, and thank you for watching the session. Don't forget you can connect with all members within the EV community. Send messages to each other and start to build relationships for the future. Also, take a look at our supplier showrooms. Our partners have got lots of products and services that they have to offer, which again could be of benefit to you. Make the most of the opportunity, and thank you again for joining us.